Let's jump right into this explainer. Today, we're unpacking the historic transformation of a true industrial giant. We're looking at Honeywell, a company that's actively dismantling its traditional conglomerate structure to unlock massive future value. It is not every day you see a $70 billion powerhouse radically rewrite its own DNA, but that's exactly what we're witnessing in 2026. This isn't just a corporate reshuffle. It is a calculated, aggressive pivot toward becoming a pure-play automation leader. So how are they actually pulling this off, and what does it mean for the future? Let's get into it.
$38 billion. Think about that number for a second. That is their record backlog in the first quarter of 2026 alone. While the company is in the middle of spinning off major divisions and selling off billion-dollar revenue streams, their core business is actually accelerating. This massive backlog proves there is immense, tangible demand for their products right now. It gives management a huge financial cushion and the operational breathing room they desperately need to execute this radical shift in strategy, all without missing a beat on their current deliverables. And that really brings us to the core theme of today's explainer, which is addition by subtraction. Honeywell is shedding historical business units that have literally been part of its identity for decades. Why? To laser focus on high-margin automation technologies. They're stripping away the complexity of being a broad industrial conglomerate to become a streamlined, highly specialized machine. By reducing their footprint in certain areas, they're multiplying their potential in the sectors that actually matter most for the future, like smart buildings, industrial efficiency, and process automation.
Let's move into Section 1, Q1 2026 Financial Snapshot. Looking at the segment breakdown, the contrast in performance tells you exactly why this pivot is happening right now. Building automation soared by 11% to nearly $1.9 billion, and that was driven heavily by double-digit growth in their fire business, particularly over in North America. Process automation also posted a really solid 5% gain. But then you look at industrial automation, which faced an 11% decline down to $1.4 billion. That drop was largely due to warehouse project timing and some softer aftermarket demand. It's a mixed bag, for sure, but it perfectly highlights why Honeywell wants to restructure. They want to isolate and amplify the winners while divesting from the heavier, more cyclical drags on the portfolio.
Stepping back to the macro view, the Q1 2026 performance is remarkably resilient. Total sales hit $9.14 billion, which is a 2% increase. But the real story here is the profitability. Despite navigating a tough geopolitical environment, including disruptions in the Middle East and ongoing inflation, they executed brilliantly on productivity. They expanded their segment margins by 90 basis points to 23.3% and drove an impressive 11% growth in adjusted earnings per share, landing at $2.45. Plus, orders grew by 7% across the board. They are clearly operating from a position of profound financial strength.
Moving on to Section 2. Spinning off the portfolio.
This timeline really untangles what is shaping up to be an incredibly busy year. It shows a rapid strategic unwinding of diverse assets. Back in April, they agreed to sell off productivity solutions and services. Then, management rallied the market on June 11th with a dedicated investor day in New York City to lay out the new vision. But the absolute crown jewel of this timeline is June 29th. That's the historic spin-off of Honeywell Aerospace, which is going to trade independently under the ticker HONN. And they aren't stopping there. By the second half of 2026, they expect to close yet another massive sale.
To really grasp the magnitude of this restructuring, look at their Warehouse and Workflow Solutions division. They are selling this business to American Industrial Partners. We're talking about a division that generated nearly $1 billion, $935 million to be exact, in 2025 revenue alone. Divesting a nearly billion-dollar revenue stream is not a decision you make lightly. It shows extreme commitment to their new identity. They're passing this division on to a specialized private equity firm so Honeywell can completely streamline its own operations and focus its capital entirely on core automation software and systems.
All right, Section 3, Dividend and Debt Profile.
$36.73 billion. That's Honeywell's total debt as of March 2026. It's a staggering figure, but it requires some context. It represents about half of their entire $70.55 billion total market capitalization. This really highlights the absolute financial tightrope of managing an aging industrial conglomerate. Carrying that kind of leverage makes executing a flawless spin-off and restructuring absolutely critical. They need the cash flow and the operational efficiencies from their new, leaner model to comfortably service and eventually pay down these obligations.
But here's the kicker. Even while shedding massive assets and managing that towering debt load, Honeywell remains deeply committed to the shareholder. They're maintaining a highly reliable annualized dividend of $4.70 per share, translating to a yield of roughly 2.11%. The latest quarterly payout in June 2026 was $1.19 per share. By fiercely protecting this dividend, management is essentially keeping income-focused investors anchored and happy during what could otherwise be a pretty turbulent transitional period.
Which leads us perfectly into Section 4, the automation pure play.
The vision is crystal clear, straight from CEO Vimal Kapur. The dismantling of the old, complex conglomerate is meticulously designed to create a hyper-focused, domain-expert automation machine. They are shedding the distractions to focus entirely on industrial and building automation, all of which will be underpinned by their powerful Honeywell Forge software platform and accelerator operating system. It is all about doing fewer things, but doing them significantly better and more profitably than anyone else in the world.
And the financial promises attached to this new, leaner structure are definitely bold. Over the next 3 years, management expects this automation-focused portfolio to deliver organic growth between 4 and 6%. More importantly, they're projecting over 60 basis points of margin expansion annually, leading to double-digit earnings growth of over 10%. And perhaps the most vital metric for a newly streamlined company is their massive 90% free cash flow conversion rate. That means they expect this new operating model to be incredibly efficient at turning paper profits into actual usable cash.
So this brings us to the ultimate question. With full-year 2026 sales guidance still hovering near $40 billion, the engine is obviously still roaring today. But as we watch them slice away billion-dollar divisions and spin off their legacy aerospace wing, we're left to wonder, is this aggressive addition by subtraction strategy exactly what this historic company needs to dominate the next decade of automation, or are they giving up the diversification that protected them in the past? Only time will tell, but one thing is for sure. The new Honeywell is going to be leaner, hungrier, and entirely focused on the automated future. Thanks for joining me on this explainer. Keep asking the hard questions, and I'll catch you next time.